What if I told you that the safest financial decision you've been taught since childhood is quietly bankrupting you? Think about it. You've been told to save money for emergencies, for retirement, for that dream vacation. But here's the uncomfortable truth. While your savings account balance grows, your actual wealth is evaporating. Right now, as you watch this video, your hard-earned money is losing value, not because you're spending it, not because the bank is stealing it, but because of something far more insidious, a silent thief that's been operating in plain sight for over 50 years. The wealthy don't keep their money in savings accounts. They know something you don't. By the end of this video, you'll understand why your bank account might be your worst investment and what you should be doing instead.
Let's rewind to a time when saving money actually made sense. Before 1933, the United States operated on the gold standard. Every dollar in your pocket was backed by actual gold sitting in a vault. Your money held real, tangible value. If you saved $100, it would still buy you roughly the same amount of goods a decade later. Throughout the 1940s to 1960s, Americans saved religiously. The average savings rate hovered between 8 to 10% of income. People trusted banks. They trusted their currency. Grandparents would stash away money in savings accounts and watch it grow, confident that their purchasing power remained intact. This was the era when a dollar was truly a dollar. Interest rates on savings accounts were decent, often matching or exceeding inflation. Your money wasn't just safe, it was actually growing in real terms. Families could save for homes, retirements, and education without sophisticated investment strategies. But then something changed. A seismic shift in August 1971 would transform money itself and make the simple act of saving a losing game.
August 15, 1971, Washington, D.C. President Richard Nixon appeared on national television with an announcement that would reshape the global economy. The United States was abandoning the gold standard. No longer would dollars be convertible to gold. Money became an idea. A promise, pure fiat currency. This Nixon shock unleashed something that had been contained for decades: inflation. The 1970s became a nightmare for savers. Inflation exploded, reaching over 13% by 1980. If you had $10,000 in a savings account in 1970, by 1980 its purchasing power had been slashed nearly in half. The money was still there, but it could buy drastically less. Fast forward to today in 2026. While inflation isn't at 1970s levels, it's been averaging 3 to 5% annually since 2022. That might not sound dramatic, but here's the reality. Most savings accounts offer less than 1% interest. Do the math. Your money is losing 2 to 4% of its value every single year. The silent thief? Inflation. And it's been picking your pocket while you sleep. But why does this keep happening? Who benefits when your savings shrink?
2008, the financial crisis hits. In response, central banks worldwide slashed interest rates to near zero. Some even went negative. The Federal Reserve launched quantitative easing, essentially printing trillions of dollars. The goal? Stimulate the economy by encouraging borrowing and spending. But here's the twist. This crushed savers. For over a decade, from 2008 to 2021, savings accounts offered interest rates below 0.5%. Meanwhile, inflation continued eroding purchasing power. Savers were punished. Borrowers and investors were rewarded. Then came 2020, the pandemic. Governments unleashed unprecedented stimulus packages, more money printing, more currency devaluation. The result? Inflation surged to 9% in 2022, levels not seen in 40 years. Savings account interest rates finally started climbing, reaching 4 to 5% by 2024. Sounds good, right? Wrong. Even at 5%, you're barely keeping pace with inflation. You're running on a treadmill, not moving forward. Here's the dark truth. The system is designed this way. When central banks print money, the new currency doesn't reach everyone equally. The Cantillon Effect describes how those closest to the money printer, banks, large corporations, the wealthy, benefit first. By the time that money trickles down to ordinary savers, prices have already risen. Translation: the inflation game is rigged. Savers lose. Asset holders win. Still think your savings account is safe?
Let me paint you a picture with real numbers. In 2000, you diligently save $10,000 in a high-yield savings account. You're responsible. You're doing everything right. By 2026, thanks to compounding interest, averaging a generous 2%, your account shows roughly $16,000. Impressive until you account for inflation. Due to cumulative inflation over those 26 years, your $16,000 in 2026 has the purchasing power of approximately $8,000 in $2,000. You saved diligently for over 2 decades and lost purchasing power. This is the hidden truth they don't teach in school. Saving money in traditional accounts is a guaranteed way to get poorer in real terms. Meanwhile, during that same period, if you'd invested that $10,000 in the S&P 500, it would be worth over $60,000 today, even accounting for market crashes. The 2020s have shown us the alternatives: cryptocurrency surges, stock market booms, real estate appreciation. Young people are abandoning savings accounts entirely, seeking returns elsewhere, because they've realized what the wealthy have always known: cash is trash in an inflationary world. So who's really winning from this system, and what should you do about it?
Let's be clear. Emergency savings are essential. You need 3 to 6 months of expenses in a liquid, accessible account. That's your safety net. But beyond that, keeping large sums in a savings account is financial self-sabotage. Here's what the data shows. S&P 500 Index average annual return of 10% over the past 50 years. Real estate average appreciation of 3 to 5% annually, plus rental income. Bonds, lower returns, 4 to 6%, but more stable than stocks. Savings accounts, 0 to 2% after inflation, equals negative real returns. The gap is staggering. Over a 30-year career, the difference between saving and investing could literally be millions of dollars. Here's your action plan. Step 1, build your emergency fund in a high-yield savings account. That's non-negotiable. Step 2, beyond that, invest. If you're new, start with low-cost index funds. They track the entire market, require no expertise, and historically outperform 90% of professional investors. Step 3, diversify. Stocks, bonds, real estate, spread your risk. Don't put all your eggs in one basket. Step 4, start now. Time in the market beats timing the market. Even $100 a month compounds dramatically over decades. Step 5, educate yourself continuously. The financial landscape is always changing. Yes, investing involves risk. Markets crash. But over long periods, diversified portfolios have always recovered and grown. Savings accounts, on the other hand, guarantee you'll lose to inflation. The choice is yours: certain slow loss or potential significant gain.
Here's the uncomfortable reality. The rules of money changed in 1971, but most people are still playing by the old playbook. Your parents and grandparents could save their way to prosperity because the economic conditions allowed it. That world no longer exists. Today, you must invest to preserve wealth. Saving is for short-term security. Investing is for long-term prosperity. But here's the final question that should keep you thinking. What if another economic shift is coming? What if the next decade transforms finance even more radically than the last 50 years? Digital currencies, AI-driven markets, new monetary systems. The game could change again. The only way to stay ahead is to stay informed.
If this video changed how you think about money, hit that like button, subscribe for more financial truths they don't teach in school, and drop a comment below. Are you a saver or an investor? What's your strategy? Because in the game of wealth, knowledge isn't just power, it's profit. See you in the next one.